This is gonna blow your mind. Trump's tariffs have unleashed a $2 trillion shockwave, sending the market into an unprecedented freefall. April 3, 2025, will be etched in market history as a day of unprecedented turmoil. The Dow Jones Industrial Average plummeted nearly 4%, shedding over 1,600 points. The S&P 500 wasn't spared, plunging 4.84% and erasing nearly $2 trillion in market value. This dramatic sell-off, the worst since the dark days of 2020, was triggered by a single catalyst: President Trump's bombshell announcement of sweeping new tariffs. The market's reaction was swift and brutal, reflecting the deep-seated anxieties surrounding global trade and the potential for a full-blown trade war. Investors, already on edge after weeks of escalating trade tensions, were blindsided by the sheer scope and scale of the new tariffs. The news sent shockwaves across trading floors, triggering a cascade of sell orders that overwhelmed even the most sophisticated algorithmic trading systems. This wasn't just a market correction, it was a full-fledged market meltdown, a stark reminder of the fragility of investor confidence and the interconnectedness of the global economy. As the closing bell rang, a palpable sense of fear and uncertainty hung in the air. The question on everyone's mind was simple yet chilling: how much further could this market fall? President Trump's new tariffs, unveiled late Tuesday afternoon, were nothing short of a declaration of economic war. Effective April 5th, a baseline 10% tariff will be imposed on all imports from every country. This blanket tariff, unprecedented in its breadth, is just the tip of the iceberg. Countries that currently impose tariffs on U.S. goods will face even harsher retaliatory tariffs. China, already embroiled in a protracted trade dispute with the United States, will be hit with a staggering 54% effective tariff rate, including existing duties. This represents a significant escalation of the trade war, a move that threatens to cripple global supply chains and send prices soaring for consumers. The administration argues that these tariffs are necessary to protect American jobs and reduce the trade deficit. However, critics argue that they are counterproductive, amounting to a self-inflicted wound that will harm American businesses and consumers more than anyone else. The timing of the announcement, coming just weeks after the president declared victory in trade negotiations with China, has only added to the sense of confusion and uncertainty. The impact of the tariff announcement was felt across all sectors of the market, with few safe havens to be found. Multinationals and importers, heavily reliant on global supply chains, were among the hardest hit. Nike, Apple, Five Below, Dollar Tree, and Gap all suffered double-digit losses, their share prices plummeting as investors fled to the sidelines. Tech stocks, darlings of the recent bull market, weren't spared either. Nvidia and Tesla, often seen as bellwethers for the tech sector, both tumbled on the news. The sell-off extended beyond large-cap stocks, with small-cap stocks entering bear market territory, down over 20% from their recent highs. Amidst the carnage, there were a few glimmers of hope. Coca-Cola, a classic consumer staple, defied the downtrend, hitting a record high. This suggests that investors are seeking refuge in companies with strong brands and predictable earnings, even in the face of economic uncertainty. The bond market, often seen as a barometer of investor sentiment, also reacted sharply to the tariff news. The yield on the 10-year Treasury note, a benchmark for borrowing costs, plunged to 4%, reflecting a flight to safety as investors sought refuge in government bonds. The market meltdown has elicited a chorus of condemnation from economists and market experts. J.P. Morgan economists warned that the tariffs, if left unchecked, could push the U.S. economy into a recession. Marianne Bartels, chief investment strategist at Sanctuary Wealth, cautioned that the S&P 500 could fall another 5 to 10% if it fails to hold the 5,500 level. President Trump, however, remained defiant, dismissing the market's reaction as a temporary blip. "The markets are going to boom," he declared, comparing the tariff implementation to a surgical operation. He argued that any short-term pain would be outweighed by the long-term benefits of a fairer trading system. Financial institutions are less optimistic. Fitch Ratings, citing the highest effective tariff rate in over a century, warned of increased recession risks and constraints on the Federal Reserve's ability to lower interest rates. UBS predicted that inflation could spike to near 5%, and U.S. GDP could be reduced by 1.5 to 2% if the tariffs are not reversed soon. As the dust settles on this tumultuous day, the full economic and political ramifications of President Trump's tariff gamble remain to be seen. One thing is certain. The road ahead is likely to be bumpy, with the specter of a trade war casting a long shadow over the global economy.